And welcome CommunityFT members to this short presentation brought to you on behalf of CommunityFT, in which we will explore the title above, or the heading above, which is Shares, Stocks and IPOs. Shares and stocks and equities, guys, are three different ways of saying the same thing, which is a portion of the overall financial valuation of a company, okay? An IPO, with respect to those three former topics, is when the shareholders or owners of any said particular company will offer to the public shares of their company in order to raise capital for their own business and organizational purposes. So before we get into this topic and explore it in more detail, let us at this point embrace a quick risk warning. If we can all now familiarize ourselves with the information in front, engage as much as is possible, simply so that hereafter, folks, any decisions you make in your trading are of a fully informed nature. Okay, so shares, guys, or equities, which is the same thing in essence, in terms of finance and company valuation, is any amount thereof, or really is a portion of the overall value of a particular company. Now, these were originally born out of necessity and were used to attribute certain portions of a company to its stakeholders or shareholders thereof. But over time, what eventually happened was the birth of multiple stock exchanges. And you can now find stock prices and trade the same virtually anywhere. And of course, that would be intensified or magnified, the effect of that, with the advent of online trading available to the lay individual. So, given that then, why don't we take some facts about today's stock market and see what's actually available to the public? Well, first of all, guys, there's many ways to trade stocks, okay? Some of the common ways, I should say, that we see now today, or that is available to us, okay, are the following. One can use a futures stock contract, okay? And this again is a derivative contract. Now, usually, guys, when people hear the word derivatives, we tend to step back and often assume that what's going to follow is a very complicated explanation, but in essence it's not, okay? A derivative, very simply, is a financial contract, and it could be any type of financial contract, whereby the value the two traders in that agreement are tracing their contract from is from an underlying asset class. So a future stock contract is a derivative whereby the underlying input or asset is the spot price of that particular contract. So the spot price of that particular stock, I should say. So if it was a future stock contract on Apple, the value of the future stock contract would be against, or would follow, the underlying input, which would be the spot price of Apple. In other words, what is Apple trading at right now? There's also another type, guys, which is more popular among the lay individual, and that is the options stock contract. Okay, that's quite popular. The only issue with the options stock contract is what we've seen now being greatly available to everyone is this idea of being able to trade binary options. Binary options effectively limit your opportunity to make profits because of how limited they are in their creation. So options might sound nice, they might be quite palpable, or palatable I should say, to any individual approaching stock trading from a lay perspective, but in essence it's not actually the most profitable way because of how limited they are. Now, again though, because of how easy it is, okay, and yes, all these contracts would come into play for the lay individual to gain access to such stocks and markets, the original purpose, which is to actually value the value, or which is to reflect the value and well-being of any given company, has been lost over time. And that's because when things are publicly traded, guys, you have people looking solely for profit and movements in the same based on that. So, before we conclude, let us switch to the chart, guys. And what we're looking at now is a daily chart of Pfizer. Okay, as I'm sure most of you know, Pfizer is in the pharmaceutical industry and produces cosmetics and pharmaceuticals then for the general public, okay? Pfizer and the stock price are the same. We can see here, guys, since we're back now on August 2013, has varied greatly since then, okay? Has varied greatly. And one very interesting way to look at this, you could say, has the actual position of Pfizer and their organization really changed this much? So in other words, if the stock price is actually reflecting the value of Pfizer as a company, is Pfizer really this dynamic as an organization? Can it really change this much or have this many changes in 2 years? And of course, most of us then would say that no, that isn't the case. So what are the underlying inputs? What's causing this to change, okay? Well, like we discussed earlier, with the advent and birth of online trading, the original purpose of stock markets has been greatly lost. And a lot of this can come from order flow and shifting supply and demand in the market, which simply comes from individuals who are following, let's say, retail or layman indicators, which make certain assumptions on price movement, which would then prompt an individual to place orders. And because of that order and order flow, and if the volume of that order flow is sufficient, that can cause price fluctuations. And we can see that if the purpose of this market is to actually reflect the value of Pfizer in this world, that purpose has been slightly lost as a result of that. But this is not a case, guys, where we're trying to approach this from a moral hilltop or a moral perspective, okay? What we're trying to help you understand here is that, let's say you are going to trade this and approach this, which is a perfectly natural thing to do and is perfectly healthy when done correctly. You need to know that it's not going to follow a logical path or a logical flow whereby the value of that always reflects what the value of Pfizer is because of the background reasons we've discussed. So effectively then, what that leads us to assume is that you need a tried and tested methodology or strategy that's based on the facts of the chart, not necessarily the fundamental inputs of the actual company or underlying asset class. And that can be highly lucrative, okay, or exceptionally dangerous without proper capital risk management. The price of the stock, guys, okay, fundamentally fluctuates due to the theory of supply and demand. And like all commodities in the market, the price of a stock is sensitive to demand. But the factors that change this demand, guys, is not necessarily linked to individuals who want to invest in Pfizer or who want to get away from Pfizer because of the direction of that company. It's oftentimes simply linked to the direction of their intent, which is to make profit on the fluctuations in Pfizer, which brings volume to the market, which causes the market to not move in a manner that truly reflects the value of Pfizer. And what we need to do is effectively take into account all those factors and then devise a strategy based thereof, because that will be a lucrative system, and that takes into account the facts of what we see on the chart. So I hope that's been of help, everyone. If you have any further questions, please do not hesitate to get in touch. We welcome all inquiries. If you would like to ask us anything, we definitely would like to help out. So have a great day, guys. We'll chat soon.